Is the historic gold rally dead? For the last few weeks, the momentum has stalled. The price of gold has hit a wall, catching its breath right here, while the financial media is already starting to pivot. They're telling you the pullback is real, that the run is over, and that a crash is coming. But what if I told you this pause is not a crash, but the single most important setup for gold's next explosive leg up? We are talking about the final launchpad for a move that could see the precious metal surge to a staggering $5,000 per ounce. In this deep dive, I'm breaking down the three non-negotiable forces that prove the gold bull market is far from over. Stick around, because the last one is the hidden catalyst that no one is talking about. Welcome back to the channel. I'm Your Name, and you're watching Your Channel Name. Let's get straight to the charts. Gold has had an incredible run, fueled by geopolitical risk and central bank buying. But now, as you can see, we are in a period of consolidation. This is where most retail investors panic and sell. The key to long-term wealth, though, is understanding why the market is resting. Right now, the market is digesting a stronger than expected dollar and profit-taking from the recent surge. We saw a high of current high, and the current support is holding at current support. This is healthy. Bulls are simply taking inventory before making their next move. But the big question remains: what drives gold from its current price to the promised land of $5,000? The first and most powerful driver is the unprecedented central bank buying spree. Look at this chart. Central banks, led by countries like China, India, and Poland, are buying gold at a near-record pace. They aren't short-term traders. They are strategic, long-term players de-dollarizing their reserves. Why does this matter? Because this creates a massive, consistent price floor for gold. Since 2022, they've added over search result chart example tons of gold. This isn't speculation. It's a structural shift. The smart money knows the global financial landscape is changing, and they are preparing for a world with less dollar dominance. This non-stop institutional demand is a $5,000 fundamental tailwind. Next, let's get into the technicals. We're going to zoom out and use the logarithmic chart, the only way to truly understand a multi-year trend. The $5,000 target is not a guess. It's based on a classic technical pattern. We need to look back at the 1970-1980 cycle, which saw gold's price nearly quadruple. When you apply the Fibonacci extensions from the last major correction and combine them with the historical expansion zones, the $5,000 level aligns perfectly with the 1.618 Fibonacci extension. What we are seeing now is a retest of the previous all-time high zone, a classic Wyckoff accumulation pattern. The moment we get a confirmed daily close above the XXXX level, the final resistance from this consolidation, that $5,000 target becomes a high-probability trade. Pause for a deep breath. This is the technical roadmap. Now, for the most crucial catalyst, the one you won't hear on mainstream TV. Gold's role as the ultimate hedge against fiscal inflation. Everyone talks about CPI and consumer prices, but the real threat is governments devaluing their debt through massive spending. As debt levels in the US and globally hit astronomical highs, the only path forward for many nations is to let their currency slide. Gold is the exit door for smart money. Furthermore, the rise of deglobalization, trade wars, and political uncertainty forces capital into non-sovereign assets. Gold is stateless, non-correlated, and cannot be printed. The next crisis won't be a housing bubble. It will be a trust crisis. And when that hits, the flow of money into gold will be a tsunami. $5,000 will simply be the first stop. Okay, so we have the fundamental drivers and the technical targets. But every trade has a risk. The primary risk is a global deflationary spiral, which would see a massive flight to the dollar, crushing all commodity prices. However, given the current geopolitical landscape and central bank policies, this is a low-probability event. So what is the plan? I am currently watching for a retest of the specific support level. If that holds, my accumulation zone is between XXX and Y or 1YY. My ultimate long-term exit target remains $5,000, with a major stop loss just below the key psychological support at ZZZZ. Remember, this is not financial advice. This is my analysis. Always do your own due diligence. Gold is not crashing. It is gathering strength, breathing, and preparing for the next historic move. The central banks are giving it the floor, the technicals are giving it the roadmap, and the global debt crisis is giving it the fuel. The $5,000 target is no longer a fringe theory, it is a base case. Now I want to hear from you. Do you think gold can hit $5,000 or is a crash imminent? Let me know your price target in the comments below. And if you want to know what this gold rally means for its little brother, silver, which I believe could see an even bigger percentage gain, then click on the video on your screen right now where I break down the silver-gold ratio and the next major target for silver. I'll see you there.